The maximum amount of money that you can put into a Roth IRA is $6,000 per year. Unless you're 50, then you can do $7,000. But if you know about the back door, you can put a whole lot more money in. Be sure to stay tuned to this video because we'll be digging into exactly that. For the financially savvy, tax-saving strategies drive a lot of our personal finance decisions. Avoiding or lowering taxes can influence where you choose to live, what kind of car you buy, how you structure your business, how you take vacations, how you set up your estate, and so much more. Almost everyone tries to limit the amount of taxes they pay, and taxes play a larger role when we invest for our retirement. One potential way to minimize taxes is to invest in a Roth IRA. Again, with a Roth IRA, you contribute after-tax dollars and withdraw any earnings tax-free in your retirement years. Traditional IRAs work the other way with pre-tax dollars going in, but you're taxed when the money comes out. There are three types of ways to fund your Roth IRA. You can do that through annual contributions. You can do that by rolling over an old 401k or IRA balance that's set up in a Roth structure. And you can also contribute through what's known as a backdoor. And this is great for investors who don't qualify to make money. They make too much money to contribute into their Roth IRA. So let's go ahead and take a look at annual contributions first. And around annual contributions, there are a lot of questions on, when I open up a Roth, how much money do I have to put into it? Do I have to put money in every single month? Can I stop if I don't want to put money into it on a certain month? Questions like that. So let's go ahead and take a look. When it comes to a Roth IRA, as far as a minimum amount of money that you have to put in, the minimum amount that you have to put in on any given year is zero. You just don't have to put money into your Roth if you don't want to. Only if you have the money available after tax dollars. And so you've already paid your tax on it, you have that money sitting around, or you've been budgeting it, and then you contribute it to your Roth IRA either on a monthly basis, or you can do that once a year. Now the maximum that you can put into a Roth IRA is $6,000 per year, at least as of 2021. Now if you're over the age of 50, you can add an additional $1,000 and you can put upwards of $7,000 per year. Now tax day, you have to put that money in by tax day, and tax day for the next year, for 2022, I believe is April 18th on 2022. So as long as you make your $6,000 or your $7,000 contribution into your Roth IRA by the tax day of 2022, that contribution will count for the 2021 year, if you're following me on that. Now, contributions can be all at once, like we talked about, or they can be periodic. So you don't have to put your money in, but you can only put in up to the maximum, otherwise you're going to get penalized. And so if you want to set up a dollar cost averaging system where you're contributing $400 or $500 a month to your Roth IRA, and that just happens month over month over month over month, then that's great. If you want to set it up where right before tax day you pay for the previous year because you've got that extra money, then you can do that. You can also put money in the day after tax day for the next year and have that money sitting there all the way and compounding for you. So you just can't go over the maximum. And again, there's no minimum. Now, if there are two of you, meaning that there is a husband who also has a spouse or a wife who also has a spouse, and your spouse is not working, then you have a second neat little feature that you can do, in that you can make a contribution to a second Roth IRA on behalf of your spouse if they don't have earned income, or if you guys combined don't go over the limits. And so theoretically you could put $12,000 away, or $14,000, or somewhere in between that, depending on the ages of your spouses, and you could get all of that money compounding in a tax-free environment, and then all the gains would come out tax-free following you provide those rules. Now, your IRA and your spouse's IRA, if you contribute to that, are taken from after tax dollars. So what that means is that there's no tax deduction on the given year. In fact, you don't even need to let the IRS notify them that you put money into your Roth IRA. You just need to keep track of that contribution, because there's a thing known as the 5-year rule, and we'll talk about that in a few minutes. But the 5-year rule is going to limit, how long you have to leave your money in there before you can take it out. And when you contribute your money will affect that particular rule. Now, this is your contributions. You're making money and you're contributing money into your IRA. You have to have earned income in order to contribute to your IRA. And the money that goes into your IRA is actually pulled from your modified adjusted gross income. And so that's taking your adjusted gross income and factoring out a couple of those other deductions, backing those out. And so you can talk to your CPA on exactly what is modified adjusted gross income. But if you're single and you earn under $125,000, meaning your modified adjusted gross income is under $125,000, then you can make the full contribution to your IRA. If you're single and you earn more, your MAGI is more than $125,000 and under $140,000, then you can make partial contributions. And if you earn more than $148,000, then you can't make contributions based off of earned income. But you could get money into a Roth IRA through the back door, and we'll talk about that in a minute. Now, if you're married, your limits are $198,000. If you earn more than $198,000, your MAGI is more than $198,000. Well, if it's under $198,000, then you can contribute the full amount to your retirement account. If it's over $198,000 and under $208,000, then you get a partial deduction, or you can contribute a partial amount to your Roth IRA, is what I'm saying. And if you earn more than $208,000 as a a married couple filing jointly, if you earn more than $208,000, then you cannot contribute to a Roth IRA through the MAGI method, through your annual contributions. You can get money in through the back door if you want. Now, let's take a look at a rollover. On a rollover, that's the second way to put money in. You can roll over an old 401k, an old 403b, an old 457, and an old retirement savings plan, so long as they are of the Roth variety. And so if you have an old Roth 401k, or you have an old Roth 457, or a Roth 403b, or some other form of a Roth retirement account, then you can roll that money into a Roth IRA, no problem. And there is, you just cannot be employed at that previous employer. So if you're still employed there, unless they have this thing known as a in-service distribution, which is rare, they may have it, you most likely cannot roll over your 401k or your 403b or your 457 Roth to a Roth if you're still working there. You have to no longer be working there. Now, rollovers are not taxable. You're just taking money out of one Roth and passing it to another Roth. So there's no tax consequence on that. Now, there could be a tax consequence if you're going from a Roth, or from a traditional 401k to a Roth IRA, and that's a separate thing. We're going to talk about that in a minute. Now, if you do a rollover, they're going to mail a check to you. You're going to call up your current financial provider where your old 401k is, and you're going to say, I want to do a rollover. What they're going to do is they're going to mail a check to the financial institution where you have your Roth IRA or your IRA already open at. And so they're going to make a check payable to you, payable to that financial institution actually, for benefit of you in the name of your IRA. And so you'll roll over from a 401k Roth to a Roth IRA, or from a 401k, 403b Roth to a Roth IRA, etc. You can go from Roth to Roth, but you can't go from a traditional to a Roth. That's not allowed. All right, now wait, before we go to stage 3, which is investing your Roth IRA, I do want to spend just a little bit more time on the backdoor provision. Many investors / retirement planners do Roth IRA conversions, moving money from their traditional IRA or their traditional 401k into their Roth in order for the tax savings benefits. And this strategy is also known as the backdoor Roth IRA. And basically it allows you that for people that are normally ineligible or have too much money that want to get that money into their Roth IRA in order to do that. And I want to explain how that works. If you're above the income limits or if you have a 401k, then this is how this works. You've got your money sitting aside over here in, let's say, this 401k right here, or this IRA right here. And let's say you have $150,000 that you want to roll over for whatever reason that particular year. That's the current balance. And you want to roll that into your Roth IRA. Well, what has to happen is it has to go through the marginal tax system first. And so whether you're married, filing jointly, or you're single, you're going to take the 150, you're going to add it to your income, and up you're going to go on this level. And you're going to figure out where you fall in that marginal tax system, and then you're going to have to pay your taxes for that particular given year. And this is what I wanted to spend just a little bit of time on. Your deadline in order to do your conversion for any given year is on December 31st. And so what that means is that if it's currently the year 2021, and we're sitting here on December 9th right now, and you want to have a conversion for this year, then you have to have that conversion take place and have that money in your account by December 31st of 2021. And if you do that, then your money will count as if it was deposited into your account as of January 1st, 2021, and that will start your 5-year timer. And we're going to talk about the 5-year timer, or the five-year holding period that you have to have your money in your Roth IRA before you can take it back out again. And so if you put your money in by December 31st with a rollover, your timer will start as of January 1st, and then your 5-year timer will start kicking. So that'll be 1 year, 2 years, 3 years, 4 years, and you could actually take that money out as early as January 1st, 2026, assuming you were 59 and a half at that point in time. So essentially that's how a backdoor works. If you make too much money to contribute to your Roth IRA based on your earned income and your modified adjusted gross income, if you're above those limits and you have an old 401k sitting over, then you can backdoor that money into your Roth. Or if you just have an old 401k sitting around and you just want to transfer that money over, regardless of your limits, you can roll that money or use the backdoor to get that into a Roth. And one other key thing to understand on that 5-year timer, you might have multiple transactions, multiple 401ks that are old, or an old IRA and a 401k, and you want to roll those over into your Roth, but you want to do part of it this year and then part of it next year for tax purposes. A big question we get is, do I have a 5-year timer for that first one and the 5-year timer for that second one? And the answer is no. The very first contribution to your Roth IRA, any Roth IRA that's in your name, starts your 5-year timer for all subsequent rollovers or transfers ever in the future. So once you get that 5-year kicker going, you've met the provision, and you can transfer or backdoor more money later and still access that money as long as you're 59 and a half. Okay, well, as you can see, there's a couple ways to fund your Roth IRA. Hopefully you found the best way for you. I hope you found value in today's video. If so, please subscribe to the BrightWealth YouTube channel and click that notification bell for future videos. If you have any questions, you can definitely leave them in the comments below. And as always, our Bright Advisor team is standing by to meet with you one-on-one just by clicking the link in the description. My name is Scott McLaine. This is the BrightWealth YouTube channel. It's not what you make, it's what you do with what you make.